Remember that wild ride from the summer of 2006 to the summer of 2012? The United States witnessed its most severe housing decline since the Great Depression, triggering a global recession. But what's intriguing is what happened before the crash, the bubble era. It's like history repeating itself. Before the last housing crash, the market was on a wild journey. Home prices were slowly rising, and then bam! They exploded after 2002, turning real estate into the modern-day gold rush. Prices were going up daily, leaving buyers scratching their heads. Sound familiar? It should, because we're in a similar situation today. Today we're in the midst of what looks like a new bubble. The market has seen a steady increase in prices since the 2012 crash, and then, in 2020, it took off like a rocket. Greed and speculation are driving this bubble, and we can't help but see the parallels to the past. But here's where it gets interesting. Warren Buffett, the living legend, wasn't just sitting on the sidelines. He warned about the real estate market during the 2006 Berkshire annual meeting, right before the last bubble burst. His insights are like a crystal ball into the present. So, what's causing the concerns? The real estate market's instability is often driven by speculative investors who are using extreme leverage and a dash of greed. It's a volatile mix, and it's happening again with a surge in investor activity and risky loans. Warren and Charlie Munger have expressed concerns about these lending practices. But it's not just the residential market. Commercial real estate is also raising eyebrows. Charlie Munger recently sounded the alarm, warning of a potential storm in the U.S. commercial property market. The market's health is closely tied to the overall economic climate and the demands of businesses and consumers. Have you checked out my awesome videos yet? Every week, I give you a short, entertaining video so you can easily learn about personal finance. You don't want to miss out on this opportunity. If you haven't subscribed yet, just click that button and turn on notifications. Let's break it down. The current state of commercial real estate is influenced by several factors. 1. Economic uncertainty. The COVID-19 pandemic and its economic fallout have introduced a level of uncertainty and disruption to various industries. Businesses have re-evaluated their space requirements as remote work has become more prevalent, impacting the demand for office spaces. 2. Changing consumer behavior. The rise of e-commerce has affected the demand for traditional retail spaces as more consumers shop online. This shift has led to increased vacancies in shopping malls and retail centers. 3. Industrial and logistics growth. On the positive side, the growth of e-commerce has also driven demand for industrial and logistics properties, such as warehouses and distribution centers, as companies seek to meet the demands of online shoppers. 4. Evolving office space needs. With the adoption of remote work and flexible office arrangements, many companies are rethinking their office space requirements. Some may reduce their office footprint, while others explore more flexible lease terms. 5. Financial pressures. The mention of bad loans in the commercial property market is a concern. It suggests that some borrowers may be struggling to meet their loan obligations, which could lead to defaults and further property distress. 6. Geographic variations. The impact of these factors can vary significantly by region. Some areas may experience more severe downturns while others remain relatively stable. The big question is, how bad could the losses be? The severity of losses in commercial real estate depends on various factors, like property type, location, lease terms, and the overall economic recovery. It's a perfect storm brewing in the commercial real estate sector. Keep in mind that the commercial real estate market is inherently cyclical. Periods of growth are often followed by corrections, and these cycles can be influenced by external factors, as we've seen in recent years. The parallels between the current market conditions and the housing bubble that led to the 2008 financial crisis are concerning. The sudden price swings observed in real estate markets can lead to significant losses for investors, including those who bought into the market during its peak. The impact can extend to neighborhoods and entire regions, where plummeting property values affect homeowners, investors, and communities. One crucial aspect of real estate is that it doesn't behave like financial assets traded in live markets, such as stocks. Real estate transactions are less frequent and often rely on a few key transactions to determine prices. This lack of liquidity makes the market more prone to sudden price shifts when conditions change. Historical examples, like the 2008 housing crisis, demonstrate how quickly a seemingly stable market can turn into a crisis. During that period, some neighborhoods experienced a rapid decline in property values, wiping out substantial portions of homeowners' equity. The effects were particularly devastating for investors who had borrowed heavily to fund their real estate purchases. Warren Buffett's caution about real estate lending and speculation is rooted in his deep understanding of financial markets and investing. He highlights the distinction between responsible homeowners who buy a property to live in and speculative investors who enter the market solely for profit. When a significant portion of the market consists of speculative investors using leverage, it creates a fragile environment that can unravel rapidly. In conclusion, the real estate market is like a roller coaster, and we're on the cusp of some big drops and sharp turns. The key takeaway here is the importance of responsible lending, cautious investing, and understanding the risks. As we navigate these uncharted waters, remember that history has some valuable lessons to teach us. Thank you for joining me today. If you found this video helpful, don't forget to hit the like button and subscribe to our channel for more finance tips and insights. And as always, if you have any questions or suggestions for future topics, feel free to leave them in the comments below. Until next time, stay financially savvy and take care.